All. Welcome for virtual study course seminar on company audit. Today we are having session on company audit, valuation of shares. For that we are having a very eminent faculty from Chennai, CA T.V.Balasubramaniam sir. I request CA Rakesh Pardesi sir to introduce today's speaker.
Thank you, Vishal. Good evening all. Good evening, sir. Today we have very learned speaker with us, CA Balasubramaniam TV sir. Sir is a partner with PKF and since 1984. Sir has specialization in business valuation, business process and strategy consulting, cost reduction initiatives, forensic analysis and investigation and information technology. Sir has industry exposure in manufacturing, banking and insurance, plantations, hospitality and distribution and logistics. Sir has been involved in valuation engagements spanning in multiple countries, varied industries for various purposes. Sir has been engaged in due diligence, transaction support service across many countries. Sir has international exposure in leading assignment across over 15 countries. Sir has some professional contributions. Sir has been a member of Auditing Assurance Standard Board, has been involved in the Southern Indian Chartered Accountants Student Association activities as a co-opted council member, has presented paper in seminars for professional accountants, a faculty for the ICI's valuation and forensic course. Sir has involved in setting course curriculum and involved in training of staff regularly. With this brief introduction, I welcome Subramaniam sir and request him to take the charge of this session. Welcome, sir.
Thank you. Thank you. Without much ado, I'll straight get on to the presentation. I hope this pack has been already shared to everybody. The presentation pack is a very large one. Obviously, it cannot be covered in 2 hours. So what I'm going to do is I'm going to talk about those which are critical in this session. But as a handout, I thought it will be good to have a larger set of slides available for everyone to have a look at it as time goes. So basically, I'm going to focus on the key aspects which are there in this, and I will take you through this straight away. Thank you. We are going to today cover some basic concepts about valuation. Then there are two types of valuation which people look at regularly. The third one is cost approach, which I am not going to talk about at all. The multiple based valuation, this discounted cash flow valuation. These are two most often sought after methods, especially when we are valuing small companies, SMEs, small businesses. It's much more easier to use these depending on the availability of information, etc. So I'm going to focus more on these. And then what are the valuation assumptions which goes into it, and briefly touch upon the process and the regulatory requirements. Though, of course, the slides may have more content, but I will reduce my limited this thing to it. Then I also thought I will share some thoughts on how we can get some engagements considering the regulatory requirements, where the opportunities lie, especially considering the regulatory requirement as it's evolving. So going into some basic concepts of valuation, value could be a fundamental value or intrinsic value from a valuation perspective. This is basically what can be achieved out of it in its current position of the asset and its useful life, over the useful life, what can be got out of it. That is the fundamental value or the intrinsic value. For instance, if you have, let's say, 200 megawatt power plant, you know that in 15 years, it's going to, this is the projected production it can have, and this is the kind of PPA arrangement you have. So what kind of revenues, what kind of bottom line you can make, and the present value, that is the intrinsic value. As opposed to that, there are other possible things, like somebody could say, oh, okay, we are running a 200 megawatt plant here, and probably we have space for expanding to 3 more units. So what will happen if I put 3 more units, etc., could be the thing, but that does not get into the intrinsic value. Or second, okay, I come out of this PPA and try and do something else. Those are not probably what will go into the normal intrinsic value computations. Book value is, of course, we all know which value at which we are carrying it in the books. Liquidation value is if at all the company has to be closed and the assets have to be sold today under pressure, what will be the realization it can get. Replacement cost is the other side of looking at it from a cost perspective. What is the cost of setting up a similar business or similar asset today? So these are some basic concepts which are used. The one thing which we are supposed to specifically state in our valuation report is also the premise of value. What is the premise of value on which we are doing the valuation? So is it as a going concern, which means we are expecting the company, we all know what is a going concern. We are expecting the company to be in operation. The second is under a sale or a liquidation scenario. So these are two broad criteria. And under the going concern, there are 3 possible scenarios: value in use or value in place. It's present use. So that is one way of looking at the value. The second way of looking at the value is to look at value in exchange. What would somebody pay for it? The third is what is known as a value specific to a holder. I will also explain this. The first 2 are called the fair market value or fair value. So these are value in use or value in exchange is what is known as a fair market value or fair value. And when you come to value specific to a holder, this is known as the investment value. Simply put, let's suppose you are already a banker and you are finding another small bank available. The value you would put to it will be probably a little more than another investor, primarily because you could get some synergies and you could get some much more benefit. So what is the value it can give to a specific holder? So this is the increased value which it can bring in because he has certain benefits or advantages. A classic example which can be given is, let's suppose you already own a plot of land and the adjacent plot is coming up for sale. Now with your plot and that plot together, you can build a high-rise building. Obviously, you would pay a little more to get that adjacent plot than somebody else who can buy only that plot and build a smaller building only. This is known as a value specific to holder. So this also is used in some cases where it is required to consider like that. In a liquidation scenario, it could be a forced liquidation or an orderly liquidation. Orderly liquidation is with time, it can slowly be done. In a forced liquidation, it has to be done very urgently. There again, could have a value for specific holder. In ordered also, it could be a value for specific holder or just a value in exchange. So one is a fair value. The other one is an investment value. Again, these are under liquidation scenario. So these are the various premises of value which you may have to bring out in your report. So some examples of valuation measures which you use: company X purchases business assets from company Y. It's the fair value because it's 2 independent parties doing transaction with each other. Computation of capital gains on sale of business division of company X as a slump sale. As you know, 11 UAE applies. So it's more of a book value method. It's not a fair value. Company X acquires controlling stake in a competitor company. So because here there is a controlling stake and in a competitor company being obtained, there are other synergies which will come. So it is my specific value. So it's an investment value, which could be higher than the normal fair values. Analysts put out a buy recommendation on company's stock with a price target of 150. So this is an intrinsic value computation. The analysts normally do an intrinsic value computation and then say this is what it can reach. So you can look at buying it if the price is currently low. Merchant banker values company Y for a fundraise through IPO. This again is a fair market value, what the market is likely to pay in the current context. So these various measures may have to be used as part of your valuation engagement, depending on the purpose for which you are doing. one of the most often used method is the multiple based method, which I was telling you, and the DCF method. So now from an approach perspective, one is the market method partly, or an income method partly. So the multiple method can be based on two things. It could be based on trading comparables, which is basically other listed companies which have similar multiples. You can take an average of that, or you can take some measures from there to apply. So this is called as trading multiples or trading comparisons, which you use. Here, what you're exactly doing is you're taking, if a similar company in a similar industry, let's say a plantation industry is trading at a XPE. Now for your company, which is also a plantation company, you apply the same XPE to arrive at the value. Adjusted for other things. We will talk about those adjustments later, but broadly, the multiples are taken based on the trading companies. Acquisition comparisons are based on where transactions have happened. See, what happens is many a times the listed companies may not be a comparable to you, but there are transactions happening in even smaller companies and unlisted companies. So if somebody has bought a similar company like yours at one-time revenue, now you can also expect that your company might get a one-time revenue. So this is known as the acquisition comparisons or market transaction comparables. So this is also another method of multiples which can be used. So multiples can come from two sources. One is the market transactions which are happening. The second is based on comparable companies and their listed companies and their multiples which can be applied. Discounted cash flow is by far a very largely used method, especially in private companies, because they find it very difficult many a times to find comparables. And we all know that in India, the M&A market data, especially in the unlisted segment, is not available in a reliable data format at a reasonable cost. There are companies which do compile and sell information on transactions which are happening in various industries. The data collation itself has limitations, of course, but more importantly, these services are not cost effective for somebody who does valuation only once in a while. So that is the challenge in getting those comparisons. So many a times DCF is the most often used method in Indian context, especially for unlisted smaller companies. In value, there are a few value concepts which we need to understand. Now, whenever we are saying we are doing valuation, what are we valuing? We could be valuing the shareholders' interest, which is called as the equity value. So normally equity value denotes the shareholders' interest. There could be different terms and different categories which could theoretically come. So that is something which needs to be considered, like especially if you have equity with some options also being there, etc. There could be complexities which are coming in. There could be some convertible preference shares which are also there. All that then makes a difference there. Enterprise value is the next level of value where, independent of the financial structure, we are valuing the business alone as a business. So we don't consider what is the debt equity, how the funding is made. Independent of that, we look at the value of the business as a whole. And generally, equity value plus the debt plus preference shares and minority interest will make up the enterprise value. So this is the aggregate value at firm level. So why do we do these two things? There could be many reasons. So for example, if your client is having a business which he wants to sell, he may have borrowed some money and he may be running the business today, but we all know that, the debt cannot be taken over by somebody else. Banks want, it is especially small businesses, it is linked to the promoter or directors, and the debt is not something which just moves with the business. So quite a lot of times the sale will have to happen in such a manner that this debt is closed out, etc. So you need to value the business as a whole. And for your own reason, you may have structured the debt equity in a particular manner. The other party might look at it differently. So we are looking to put a value to the business without looking at the pros and cons of how it has been funded. So these are reasons why you may need that very often. EBIT, of course, we know, so we will not take time. EBITDA, all these are known to us. Yeah, coming to multiples. Now, multiples are always relative. So let me straight go into key things which are important in multiples to understand. Interest rates and valuation normally have an inverse relationship. So as the interest rate goes up, valuation will come down. Risk and valuation similarly has an inverse relationship. The more risky it is, the less you will have value attached to it for the same kind of returns. It's simple, like GSEC, we are willing to invest at 6%, whereas if we want to invest into the market, we want at least a 15, 18, 24% return. So that is the inverse relationship between risk and valuation. Earnings and dividend growth have a positive relationship with valuation. So the more the earnings growth in future is, the positive the valuation is. In this multiple based or relative valuation method, there are certain methods which are more often preferred over the others in different industries. And I will also explain by an example why these are, because it reflects the business model. That is what is the crux of the whole thing. So in retail, there could be earnings per share could be a measure, or a profit earning growth PEG ratio could be a measure. Footfall in the retail store could be a measure. So in cement and steel, it could be a per ton. In industrials, normally EBITDA is more preferred, though of course earnings per share could also be a measure to use. Internet is based on revenue, subscribes or page views. Banks, interestingly, banks and even NBFC based on book value. And in case of REITs, it's fund from operation or net asset value, which is used. Now, there is a very, very strong logic as to why certain methods are preferred in certain industries. We will see about that as we go down. I'll give some examples also. Now, I'm skipping some of these things to go into. We all know that, the stock markets and the prices all can vary because of multiple reasons. There is no one single thing which can exactly measure the value. So all that part, we know that. I'm just skipping those and coming to the method. In a comparative analysis or a relative valuation method, what do you do and how do you do? This is the simple thing which we are looking at. One major advantage is it's simple to implement. You don't need detailed projections for it, which you don't know whether it is right or wrong. All that will not be required when you are looking at a multiple based valuation method. So how do you do? The steps are very simple. You first select the financial performance measure, which you are going to use as the basis for valuation, whether you are going to do a sales multiple or an earnings multiple or a book value multiple. So first, I think there is some
Ajay sir.
noise.
Ajay sir, please mute yourself.
Yes. Okay.
Sorry. Yeah. Thank you. So the first step is to determine that performance measure, what multiple we are going to use. Then to determine the multiple, how do we take the multiple based on some comparable firms, right? So which can be then taken, and you can take an average or median or any other method of statistical analysis of that to arrive at the multiple to use. Then to this performance measure, apply that multiple. Now the key issues in all this is, what is a comparable firm? Which is the comparable company we can use? So that could be based on multiple things. Again, one is based on operations. So similar product services, similar line of business, similar cost structure, similar geography. You cannot compare two companies doing construction business, one in India and one in China, with the same measure. So you may have to consider these things, geography. Then who are their customers, whether it is B2B, B2C, those things will make a big difference in terms of how the numbers stack up for those comparables. So you can choose comparable firms based on that. You can also apply some financial aspects like various things like size, their sales, their market cap, their capital structure, their margins, their profitability. Various such measures can also be used to make some short list of choices which are more comparable to you. Very, very theoretically speaking, comparable firm means a firm which is comparable to you in terms of the risk profile, which is similar to yours. Growth profile, risk profile, similar to yours. That is what is the crux. It sometimes could, maybe even theoretically, maybe even from different industries, so long as they can meet this criteria. So first what you do, you determine the peer group for the target. So fine, okay, which is the industry? Engineering components or auto components. So take all the peer group companies in that auto group. Then what do you do? Gather the appropriate financial information. So pull out all the data relating to all that. So where do you get the data from? You can get it from NSE, you can get it from BSE, you can get it from some of the stockbrokers data, you can get it from paid data like Capital Line, you can get it from screeners which are there in Money Control, which is many of them are even free data which is available. You take that data, and once you have that data, you tabulate that in a simplified form and you normalize. Whatever is not comparable, etc., you remove them. Whatever is not comparable years, you remove them. All that you do, take the data which is most relevant and then calculate the multiples which you need. It could be price by equity, it could be price by book, it could be sales multiple, it could be EV by EBITDA multiple, all that, whichever multiples you want, you calculate for those companies. Now, in normalizing, one other thing you will do is that you will also eliminate those which are not really truly comparable. Maybe there are 50 auto companies which you are able to pull out data for. Then based on what I was explaining in the previous sheet, which are the companies which are more comparable to your company and which are not so much more comparable by financial parameters and non-financial parameters, you can make a selection, document that selection, why you are taking some, why you are not taking some, and then make a list. So most important here is to document that judgment as to why you are selecting some. So some of the criteria you can use is surely the financial criteria, like those which are around your size, rather than take something huge. You cannot value a small bottler with Pepsi's multiples. So obviously you need to compare with something which is more in your size. That could be one way of looking at it. Second is you can look at margins. So these are some things which you can apply from a financial perspective to shortlist from the whole list. Then you can also apply some judgmental items like, okay, are they in similar components? Are they in a very complex component? Are they in a very simple component? So you may be comparable or not comparable. Based on that, you can select some and delete the others, or leave out the others for the computation. Then once you have the multiple ready, you forecast the target's financial performance. If you are going to do a sales multiple, you need to know the sales. If you're going to do the PE multiples, you need to know the profit which the company will make. So once you have that, and if you don't have future financial performance, you can always use multiples based on the year which has just ended. So both ways you can look at, our period which has just ended. Of course, it cannot be very, very old. It has to be close to the current valuation time. That's important. Then you can apply the multiples, arrive at a value from which you can then do some adjustments for being unlisted, for control premium, if this is going to be a minority share. So all that you can make adjustments thereafter. So what is the implicit assumption we are using in using this multiples approach? First thing we are saying is we are assuming stock prices are reflective of the industry mean. So whatever you are doing, it's comparable. The industry is in a comparable form. So that is why you are taking the industry mean to do your computation. Then rely on the stock market to evaluate the prospects of profitability and growth of comparable competitor firms. That is what you are, in other words, saying is that the market understands and it has already considered and evaluated the prospects of the growth in competitor firms, which is what you are using for your multiples. And you are also assuming the similar prospects apply to your firm. Your firm is a reflection of what is there out in the industry listed. So this is one key thing which is considered in the assumption. Further, it is also assumed that whichever companies you are comparing with, the risk is the same between the companies. That is one other assumption which is going in. If you want to make changes for that, you need to adjust. Everything can be done by adjustments. Now, similarly, these examples I'll skip. So, yeah, now this is something I wanted to specifically talk about to say why a multiple method is even looked at as a method in the valuation, and why and what is the rationale behind a multiple method. Now, this is actual data from very old, as you can see, 2008, 2009 time data. You can see that for some of the companies which have been selected, this was actually what has been selected for some transaction which happened, etc. So you can see that the EV by revenue is 1.1 times. That is the enterprise value by revenue. Sales multiple is 1.1 times. Enterprise value by EBITDA was 5.9 times. And price by earnings was 13.5 times. So this was the numbers which were coming up. Now, what does this really mean from a theoretical standpoint? And I say again, theoretical standpoint, because in practice, there could always be 100 other factors which can come and twist and turn your numbers a little bit. That's why I chose BPO business especially to show this, because BPO business generally is much more rational and balanced in these kind of returns. Now, typically the business model in a BPO entity is that it has a structure whereby the prices are agreed in a manner. Generally, it generates as a business a 20% EBITDA and 8% PAT revenue. Of course, today it could have changed a little more because of the tax structures, etc. I'm talking about older time. So I'm just giving you an example of 20% EBITDA and 8% PAT to revenue. Now, if you do a cash flow based analysis, this is what you would use: a 20% EBITDA, 8% PAT arising from the business is what you would have used to get this. Now look at it in the same manner. If you take these three multiples we saw, and if we take revenue to be 100%, then automatically at 100% EV by EBITDA, using the same ratios of 1.1 and 5.9, EV by EBITDA comes to 19, which is roughly 20%. And similarly, when you take the business structure at 100 of revenue and ratio of 1.1 versus PE ratio of 13.5, you end up with a 8% earnings. So essentially, these various multiples are nothing but a reflection of the business model in that industry, assuming that the business model is comparable. So one of the assumptions we are making is that my business model and my returns, etc., and the risk attached to it is similar to the industry, which is the crux of the thing. Now, in an earlier slide, which I did not go through, there is also an explanation how DCF and PE ratio are linked to each other. So essentially, all the multiples are theoretically a reflection of the, or a simplified reflection of the underlying DCF. So this is what is the crux relationship between the methods. So this exactly is the reason why BPO businesses generally get valued on a revenue multiple, because with the revenue multiple, you know clearly how the EBITDA is going to be, the earnings are going to be, etc. There is no need to do a detailed working to profitability projections to determine the valuation. Simply from revenue itself, it could be considered, essentially because of the structure which is there. So which is what I was explaining. Now, the same thing can be applied for many other types of industries also. Like if you take cinemas, what are the key valuation drivers in cinemas? How many screens? Now today we are talking about cinemas in current context where the companies own multiple screens. So how many screens you own? What is the kind of occupancy levels you have? What is the average ticket pricing? What is the spend per head? That is the spend on other items. Like generally in all these screens, you will find that there is a huge amount of revenue coming from other sales which happens there, especially the food sales which happens there. So what kind of spend per head happens? These things, when it varies, obviously the revenue and the valuation varies. What kind of advertisement income they get and what kind of growth they are expecting could all make a huge difference in terms of the valuations they stack up. So for instance, in 2014, PVR was valued by stock analysts, and they had considered these numbers that there would be sales going from 13,000 million to 21,000 million in 2 years' time, and the EPS growth of 4%, 83%, and 41%. So significant growths happening in terms of the EPS. Even the sales, as you can see, grows by 63, 31, and 22% over the years. So a huge growth was considered. Now, this is very important to understand in the context of the overall this thing. Now, if you look at all the comparable companies across the world at that time, they were having a 19 times PE on an average, as opposed to PVR, which was at 40 times. Now you can see the future projections also. The future projections for the comparable companies, the average is expected to plunge from 19 to 14. But look at in the case of PVR, it will be from 40 to 15 in 2 years' time. Now, why so much of a drop is happening and why such a hefty premium now? So this is something which we can understand if we look at what are the drivers and what is the inputs into it. Now look at it, the kind of growth. Other companies are expected to grow at 6% and then 25% and 24%. Their earnings are likely to grow only by about 20% odd. PVR's earnings are expected to grow by 44%, 83, and 42%. So there is a huge growth which was projected for PVR, which is why currently they are valued high. But over a period, what happens is they also come to a stable state. At a stable state, they are comparable to their peers. There is no extra premium which is coming because of growth. So one of the key factors you need to understand in using multiple based valuation is what kind of growth your company is expecting vis-a-vis the kind of growth which is being experienced and is expected out of the companies you are using for comparison. I'll skip these because these are things which are not available. This again goes on to explain the model. Now I will go into the discounted cash flow model, which is very, very critical. In fact, this may be the most often used model in valuation by all of us. So in a DCF, basically what we are saying is forget everything. Ultimately, there is some money which we are putting in. There is some money which we can get back. That free cash flow, I will adjust it and discount it for the time value as well as for the risk which is attached to it. Then I get the current value. It's this is the sum and substance of what they are looking at in terms of how discounted cash flow valuation is done. So we are discounting it for two things. One is the time value. The second is the risk associated with that. So both together only the discount factor is being used. So we need to understand that. That is why different companies have different discount factors. And because of that, the valuation can vary. All of us come from the CA background. The basics of the discounting and basics of this thing, I can even skip. I don't see a big issue there. So let me go into the principle of what goes in and what does not go in. So principle is that cash flow that is not retained and reinvested in the business is free cash flow. So that is freely available for the owners to decide what to do with it. Now, as we all know, profit is something which is earned as a sales minus this thing. But if let's suppose the working capital changes, then the profit is not money available in hands. So that is one way the money gets blocked. So we are not looking at profit as the measure to determine this. We look at the cash flow as the measure. So we look at the amount of money less what needs to be reinvested for increased working capital in the company. Then the second thing which similarly affects is depreciation is not a cash flow. So obviously there is no, it is added back to arrive at the thing. At the same time, you need to keep on investing in capital projects, capital assets to be able to generate revenue. So that capital expenses will have to be taken as a cash outflow before determining what is free out cash flow which is available. Now that is what is determined here in terms of the investments which needs to be put in. Investments could be into working capital or into fixed capital. Both will have to be considered. So this is the model for it. We will see it in Excel itself as a model, how we can go about doing it. Then free cash flow can be prepared at two levels. One is what is known as a free cash flow at firm level, which is at enterprise level, before debt or debt servicing, before interest, etc. So as I was explaining, the valuation is done for the business without considering the structure of the financial gearing, which is there in the company. So the calculation is done before debt servicing, before interest and any repayments, etc. When you want to do the free cash flow to equity, what you do is you start with that. You deduct the interest payments which are made. You deduct any debt repayments which have to be made. And you also add cash raised from debt issues. And then you can arrive at the free cash flow to equity. That is what is to be to the account of shareholders. So these are two levels of valuation which can be done using the DCF. One is at the enterprise level and one is at the equity level. So this part I will actually show you on the Excel itself, so it becomes easier. But before we go on to that, I just wanted to touch upon only one thing, that what is a terminal value? Now we all know about annuities. So the assumption in a terminal, in a business valuation in DCF is, as a going concern, of course, there could be exceptions where we need to differentiate. I will also touch upon that now. But first and foremost, the assumption is in a going concern that the revenue and the business will continuously run to infinity. So obviously we cannot keep preparing cash flow projections for n number of years into the future. So normally what is done is the projections are made for 3 to 5 years, which are called as the explicit period. And how do you determine 3 to 5 years? It's generally based on the time frame required to achieve a stable state of business. That is the crux of the thing. Now, if it's an early start business, the next 5 years could be significantly high growth or high investment requirements, etc. will be there. But after some time, it will come into a stable state. So the stable state forecast is what is used for the terminal business. So you use 3 or 5 years, which are the unstable period of growth, and then you take the balance as the terminal value. So you have 2 methods to compute the terminal value. One is the constant growth method, which we will be seeing in the Excel model. So to assume that from the explicit period, let's say 5th year onwards, the growth will be 4%, 5% constant across. That is one method. The second method is to assume that we saw the relative valuation. So in the 5th year, we assume that there will be a relative valuation, multiple based valuation, which will then be discounted to today's value. That's another simplistic model which can also be used. So for 5 years, I take the cash flows and compute. And for the 6th year onward, instead of doing a constant growth method, I can say, okay, I'll use a sales multiple of 1 time. So at that time, sales is 300 crores. So 300 crores will be my valuation, which will get discounted and added to my present value. So this is another method of doing the same thing. This I will leave. I'll go to the Excel sheet now. Give me a minute. I'll share the Excel sheet, which I hope you are all able to see this. So I'm just going to start with this thing. So we know projections can be made standard P&L up to PAT. Most importantly, when projections are made, we need to project for both P&L and also the balance sheet, because some of the items from the balance sheet also affect the cash flow. So once we have these projections on hand, we can calculate the discounted cash flow, right? And I will touch upon the valuation assumptions later, but let's look at how the discounted cash flow can be computed. So we start with earnings before interest and tax. As I told you, we are trying to work out the cash flows to the enterprise level or firm level, FCFF, free cash flow to firm. So that gives you the enterprise level value. Then from there, you can adjust to arrive at the equity value. What is the value for the shareholders, net of debt, etc. So we can do that way. That is why we're starting from EBIT. And from EBIT, what happens is immediately the tax is taken as a cash outflow. Now, as we discussed, the idea is to prepare the cash flows considering that the gearing will not have an impact. So the whole of EBIT is considered as taxable, and tax outflow thereon is considered as an outflow. Then depreciation, which is a non-cash item, is added back. As you can see, then all the working capital changes. So what happens is every time the business keeps growing, obviously the need for working capital also keeps increasing. So that increased working capital input is also considered as outflow. Then whatever capital expenditure is required to achieve the profit, projected profit and loss, whatever is projected here, what additional capex is expected to be spent in each of the year, that is also considered, and any investments along with that. These investments are more to keep this business going, right? So all that is deducted to arrive at the free cash flow to the firm. So the money earned as EBIT less tax, then any non-cash items being added like depreciation, then whatever money is required for increased working capital requirement, increased fixed assets requirement, deduct that to arrive at what is the balance amounts which are available. Now, once you have arrived at that, as you can see, it is done for 6 years here, 5 years for considering the explicit period, and the 6th is being used for doing both explicit period as well as a terminal value calculation. I'll talk about this terminal value calculation specifically. I will explain that. But before that, let's complete this. Then these are discounted using a discount rate. Now, discount rate, how to calculate discount rate also we will see. And you are arriving at the discounted cash flow. Now, essentially, what does this mean? This means this is the present value of the money you expect to receive over the next 5 years and in eternity as a terminal value. So this total is the sum of all the amounts which you expect to get in future, their present value. Now, I want to touch upon this terminal value calculation here. As you can see, the calculation I will explain. We take the latest free cash flow, last year's free cash flow, and assumption here is that the perpetual growth rate is 2%. So this will grow by 2% for the next year. So 1 plus 2%, that is what is there in this formula, divided by 25 minus 2%, discount rate minus growth rate. So those who have seen mathematics, annuity is always the amount which will be get paid divided by the discount rate minus if the amount will keep on growing year after year, whatever is the growth rate. That gives the present, that gives the total value which would come on that date. So this is how the amount is computed for the future annuity of 309 coming, 309 plus 2% each year coming to you for eternity. The value of that is 1371. Now, next part is the discount factor. How do we arrive at this discount factor? It's basically 1 by 25% and 1 by 1 plus 25%, and then every year additional 25% being discounted on that to arrive at present value. How this 25% is to be taken as discount rate, or should it be something else? We will see in the WACC sheet. I will show that later, but let's finish this part. So we have arrived at these numbers, which are adding up to 625, which is the enterprise value on that day. So as I told you, we are calculating for the whole enterprise. So we are arriving at the enterprise value at that day. Once we arrive at the enterprise value at that day, then whatever is the debt which is outstanding on that date, you reduce it, because that is the only item which belongs to somebody else in the business. What belongs to you is, what belongs to the owners is the total business value less any outside debt. So the debt you reduce. Similarly, if there are large cash balances, you can add that also, because that is cash sitting in the company, which is also available to the owners as value to arrive at equity value. So that will become the equity value. Now, there are a few other adjustments also which can be made, not only cash which is sitting, There could be idle land which could be there, which is not connected with the business. Because in some year in the past, the company made good money. So they bought some 2-acre plot somewhere, and that is also lying. So that value, present market value of that also needs to be added to arrive at the equity value. Now this land, etc., is not part of enterprise value, because the enterprise value generally would denote the business value. You can differentiate by saying the business value, enterprise value, etc., in the way you draft it. So now the other key component in this, which is the discount rate, let's look at that, how that is computed. The discount rate is computed based on, because we are doing at the enterprise level, we are going to do considering both debt and equity. And the debt and equity ratio is around 40. That's what is the assumption taken here. This can be based on actual book values or as market values as of now, or the industry average. What is the debt equity industry average? You can use any of those to determine how you are going to take this. Most important is you should be consistent in using it, not only in one engagement, but across engagements. And also it should be fairly reflective for the purpose for which the valuation is being done. For instance, if it's a valuation being done for the purpose of determining impairment, it is more appropriate to take their existing debt equity ratio. Whereas if it is to dispose the company to somebody else, it is more appropriate to take a debt equity ratio which is normal in the industry rather than yours. Probably you are zero debt company, whereas generally the industry works on 1:1. So it is better to use 1:1 and do the valuation is more appropriate. Yeah, coming back to this, the basic weightage of equity and debt is derived from 140, right? 100 by 140 and 40 by 140. An interest rate, I've just taken a, just a number I have taken here, 24%. It can be anything which is actually applicable. Normally, how do you take the interest rate? In India, one convenience is there. We don't have very, very complex structured document and loan structures. Most of our loans are simple and straightforward. So you can take the term loan rates, and if they have hefty processing fee, you can add a percentage or so for that also to determine what is the interest rate you should consider. So that debt which they have taken at what rate they have taken is the ideal thing to take, and whatever is the tax rate applicable. Equity, cost of equity has to be computed. So cost of equity is a computation down below. As you can see the formula also, it comes from D20. So let's look at how the cost of equity is computed. And the idea of giving you this whole template is that tomorrow, if you are going to prepare something, you can use these and modify to the requirement. WACC and all straight away, this can be taken as a model and used. Of course, you need to change the numbers case to case and time to time. First is the risk-free rate. For risk-free rate, what you can do is there is a FBIL report coming every month, and it gives you the interest rates for different tenors. You can take 10-year government security tenor interest as the risk-free rate at the valuation time. FBIL publishes a monthly report on the market, which can be used for this purpose, and easily that information can be taken from there. The second thing is the market risk premium, or not premium, market risk. Market risk is basically theoretically the risk-free rate plus market premium. How you can compute this is you can take long-term returns from the stock market as an indicator. Now, typically 15-year returns from the stock market are hovering around 15-16% now. So you can take that as an indicator. You can do your own computations also for that. the most simplistic computation would be take the Sensex today and take the Sensex 15 years back, see what is the average return on it or annualized. Or you can do it a little more sophisticated manner, taking monthly returns and then averaging it, because there could be spikes and troughs happening in market. We all know that. So something like that can be built to arrive at your own market risk indicator. So next thing which is required is beta. What is beta basically? Beta is essentially the indicator of how your stock is volatile compared to the market. Now, generally the stocks have different tendencies. Some stocks move with the market, some stocks move in the opposite side of the market. Some stocks move faster than the market, some stock moves slower than the market, but they move in the same direction, etc. So this beta essentially determines the kind of volatility to the market to your stocks. Beta information is being published by Ashwath Damodaran in his site every year. And as this does not change too much, it is best to take from that for your industry or the nearest industry which is comparable to you, so that you have some ready source of data. I'm also talking about where from you can take the data so that it can easily be done by you without having to spend too much time and effort on it. It is actually one of the challenges Indian valuers have is finding data from the Indian market. A lot of analysis and data are not readily available. So this could be an easy source of getting that information. So once you have that, the formula is a simple formula. It is a risk-free rate plus market return minus risk-free rate, that is the premium, into beta. So the premium, if it is comparable to the market, it's only the market premium which will come. If it is more riskier, beta will be higher than 1, so you get a higher premium. So that is how you calculate the cost of equity. And then the cost of equity and cost of debt together makes up the weighted average cost of capital, which is what is used as the discounting rate. Now, of course, I have not linked this here. I've just put some number here. Actually, this should get linked like this to have the same thing running, right? Just to give an idea. So this is how a simplistic DCF model can be prepared and run for doing valuations. Now, okay, the template is there, the WACC calculation method is there, there are some sources from which you can take the data. So what is the input which is required? Where is the valuer's judgment coming in? This is where, as chartered accountants, we can bring in value surely. This requires projections. Now, how are we going to satisfy ourselves that the projections have been made reasonably on a acceptable manner, though we are not passing an opinion on it? We need to ensure that there is some logical story to it. And how does this projection compare with the past history? Now, here I am talking about 2,400 million turnover and going up to 6,000 million turnover, etc. on top. What if my previous 5 years turnover is only 50 crores? So how is this storyline going to be built? What is the business logic behind it? Does it sound logical, considering that there will also be not only this company will be acting, all their competitors will also be acting? Whether in that context, whether these look reasonable, whether the kind of returns then they have projected looks reasonable. For example, for the revenue they have booked, have they booked costs? For the revenue they have booked, have they ensured there is already capex spent on it, so that the manufacturing facility or the fixed asset facility which is required is already available, or has it been projected in the balance sheet for further capital infusions? These are critical things. Then there is one more thing where there is a need to apply mind. Whether the company has the money. Now today I might have just started a company with 1 lakh. Then I can easily sit and prepare a projection saying that I am going to do 5,000 crores of business, etc. But to do that, it's a chicken and egg situation. First, we need to put in the capex, then we will start getting revenue, etc. So first to put up the capex, where is the money going to come from? Has that been tied up? Is there a logical rationale to this whole projection in the context of where the company stands today? This is one very important thing which needs to be considered. Not only considered, in my view, this should be brought into the report very, very clearly. So the report should talk about analysis of the past historical performance, and then from there build a bridge as to how it is going to translate into the projected numbers in terms of the business plan they have made. With that, now I will come back to the presentation. I'll just reshare the file. Yeah, I think we are back here. So now, with this background, I want to talk about 10 or 15 key things which are important in the DCF valuation and what we need to consider in terms of that. In terms of the arithmetics, the model sheet is there already. I've also shared it. So it's easy to handle that once you have some numbers there. Second is in terms of the assumptions which have to be taken for valuation, like the market return, the risk-free rate, the beta, etc. I've talked to you about the sources from which it can be looked at. Of course, then there can be some adjustments, etc., which can be worked to that based on how you look at individual cases. We will also talk about some discounts, etc., later. But in the valuation projections, which are the crux of the valuation in a DCF model, how do we look at some things and what do we look at in those things? First is the sales estimation. Every projection starts with the business revenue projection. So what is the industry trend for the market growth? What is our market share today? And what do we expect our market shares to be in future? For instance, if the market itself is growing only at 2% and today I already have 20% market share, I cannot expect to grow at 500%. There is an issue. I cannot become bigger than the market. So how is this projection comparing with those and whether that makes logical story? Again, when we are valuing small businesses, this may not materially matter because the market size is so huge and we will be talking about a very small share in that anyway. But these are concepts which we need to keep in mind. For example, if the market itself is growing only at 2%, how do we expect my company alone to grow at 10%? Is a question which needs to be answered very clearly in the projections by the company. And we need to also bring it out in our report to say that this is what the company is expecting to do and things like that. Of course, non-confidential information, but yes, we need to bring it. And do we also consider what kind of sensitivity will be there to the actions by the competition? See, it's not that we are the only ones who are going to act. Somebody will come and say, oh, no, today I have only 2% of the market share, but I am going to become 79% market share by 5 years. Now, I'm sure all the other competitors are not sitting by the side and watching whether you are growing or not. They are also going to do something to keep their share or increase their share. So in the context of all that, how is this considered is something very important to look at. Classic example we had was that in a hotel project where they had projected growth in revenue, and they just took Excel sheet can merely give you any number of growth, whatever you want, it can give you. But it was a hotel project, which means there are given number of rooms only for sale. There is not something more available. So revenue is dependent on number of rooms number of room nights which will be occupied, and the rate at which you can sell per room night. Only three things. Number of rooms is fixed. Occupancy can maximum be 100, and even 100 can never be generally achieved. So the only thing is the rate, how much the rate can grow. So ultimately, we saw that the kind of numbers they had put, when you compare with HVS study, HVS is a hotel specialist company which publishes data on future trends of hotel industry. Now, this requires a 25% more than the future rate trend as projected by HVS. Now, HVS is a industry expert. He has projected something and you expect to do 25% more than that without some logic. Doesn't jibe. So it had to be killed. We had to change significantly. The next other thing which you need to consider is that initial years, the growth rate will look to be very high, but over a period, the growth rate will taper down to matching with the industry. More or less, it will be. We also did our own analysis of about 3,400 companies, 5-year growth data, and we found that the cost structures also vary between them. That is, the high growth companies are also considered as high risk, which means they are in the early stage where there is a higher risk. So that is also something which you need to factor. So over a long period, your growth rate cannot be higher than the industry growth rate, which also in a very long period cannot be more than the economic growth rate. So theoretically, ultimately, everything comes down to that economic growth rate. So this is a study which was done in US over a 40-year period. Now, what they found was that at the time of IPO, the companies were doing 15% more growth than the market competitors. 15%. But by about 5th year, their growth rate is similar to the industry, period. This is what they found that. So what it shows is that the growth rate cannot be significantly higher than the industry forever. It has a time period because there are people who will act, etc., etc. In the normal course, they will taper down. In the normal course, again, there can be exceptions like Apple, which seem to be doing something which not others are doing. So anyway, by and large, the crux of it is we need to be very careful. And this one aspect dropped the value by about 25% in that example which we had. It's a practical case where we had advised. So it would come down by about 25% on that. Now, these kind of fallacies is what happens in some of the deals. Now, in 99-2000, CFI bought India World at 500 crores, 499 crores, like a bata price, right? This was a very highly talked about deal at that time because 500 crores, this was unheard of at that time. A deal of this size was unheard of in India, and that too for a .com company, India World. Now, at that time, India World had 1.3 crores of revenue and a bottom line of about 25 lakhs. And somebody was willing to pay 500 crores for it. Now, on a hindsight, when we do a justification to run it at the kind of discount rates which would have been running at that time, etc., if the revenue doubles every year, that is, one becomes two. We all have heard about that geometric mean in the chessboard. So it's like that. Every year it has to double from the previous year for one full decade. Then only this kind of valuation can be justified. But 5 years later, revenue was only 10 crores. But by the doubling, it should have become at least 42 crores. It was 25% of what was expected, or 4 times less than what was expected to justify that kind of a valuation. So these are basically issues which can come up if we don't consider the projection appropriately. So that is one key area to look at. So the next big item which will come is the cost of goods sold. If the revenue is there, then obviously the cost of goods sold is there. What are the historic trends? What are the industry trends? What kind of strategic initiatives the company can bring in or the buyer can bring in, which can make a change to the cost of goods sold? What kind of R&D or technological impact is being talked about? And what is the sensitivity? In all this, one of the sanity check we can do always is to do a sensitivity. Again, taking a classic example, it was a food business group which was acquiring a very small unit, which was in ready-to-eat business. The raw material cost structures of the ready-to-eat business was high. And because of that, it was resulting in near zero valuation. So here, the buyer is a large group in food business. They are buying a small company which was in ready-to-eat business. And the small company's current cost structures was such that if you value it, it was coming to near zero valuation. Now, this is where that investment value we were talking about, the strategic value we were talking about comes into play. So what they did, they looked at the position of the small company. And because the acquirer is a large food player, if he can bring in the same kind of procurement efficiencies, he could reduce the raw material cost by 2%. Now, if raw material costs changed by 2%, the valuation completely changed and it became a very, very critical point for the deal to actually succeed and happen. So these kind of inputs also needs to be considered in this thing. The third issue which needs to be looked at is the overheads, all the other costs. There could be historic trends, there could be general economic outlook, there could be changes happening because of the ownership, synergistic benefits which can come from the transaction itself, so which is what changes because of the ownership. All this can have significant implications. Again, taking an example, a Middle East company wanted to expand its capacity. So they thought that an expansion would be in a different location to benefit. That is, they thought instead of having capacity expansion in the same place, they will go and put up a second plant in a different city where they will get some subsidies. There will also be better tax regime, so lower tax, and it will be newer, closer to the newer markets which are being explored. So at the initial workouts, everything, it looked like a great value enhancer. They said, wow, fantastic, we should do this, etc. But when the projections were rolled out, it was found that the second location meant nearly replicating the overheads. So the overheads was going through the roof, doubling the overheads nearly. So the overhead costs were so high that they were absorbing the whole benefits which would come from the subsidies, the lower tax. All that benefit was being lost because of the huge overhead they had to incur if they had to replicate the facility elsewhere. So finally, in fact, after looking at this kind of overhead implication, they didn't think of the overhead implication on the transaction. So once they looked at it, they went back to the drawing board to expand in the same place. So this, and then only do marketing at the other location. Interest costs. Now, here also there could be change. Current range which are enjoyed by the company or the industry, which needs to be looked at. What is the outlook for change in rates as it moves now? What is the outlook today? Any change in the interest rate due to change in control. This is also very, very critical. Again, because these are mostly we are talking about unlisted companies which we are handling in valuation. Depending on the owner and depending on their strength, the interest rates they could get and from the market could vary, and depending on the kind of security they can provide, especially collateral securities outside the business, there could be significant changes to the interest rates. In a particular case, we found that a large corporate had multiple business units, very large corporate. A very large corporate and it had multiple business units. So they had a very low interest rate. So when they proposed to sell one of the business unit, it was a very, very small business unit. They wanted to sell it. The buyer was a very small, he was a SME entity. Now, originally the projections as presented by the seller was considering the lower interest rate. And obviously that meant better valuation. Now, when that was changed, the valuation fell by about 10%. Now, this, if it is not properly at that time looked at, why I'm raising these various things is to give that, flavor of what can be the judgment or where we need to bring in exercise our judgment and advise or consider in the valuation report appropriately. Taxation again could be another major impact. Current applicable rates, changes which can happen, then any tax losses which can be lost. I mean, most of the transactions which will involve SMEs, there could be loss of carry forward losses. So these things will have to be also considered very clearly. And sometimes even the tax rates could change because of change in control. So that is something also which needs to be specifically considered. These are some examples. Essentially, it is now more to do with the structure and change in control. Like we were talking, when you do a projection, when you have revenue growth, it is common business sense to understand that there will also be additional working capital required. As your business grows, working capital requirement will also go up. Unless the business model is also going to change. So this is something. Sorry, one second. I think I lost the screen share. Yeah, back. Sorry. So working capital requirements also should be considered. So typically you use patterns like, what is the credit period you give and what is the credit period you get? What do normally in the industry people get? So all that which needs to be considered. And here there could be again changes because today you might be servicing somebody in the group. So there might be some favorable credit terms which are being extended. And tomorrow, once the business changes hands, the favorable terms may no longer be applicable and you may have to look at different terms. So which might mean more working capital to be brought in suddenly, etc. So whether those have been factored and considered is something you need to specifically see. Here, the classic example is that if you look at hotels, large volume of business were coming from corporates, and typically the booking will flow from the company. See, if you remember, or if you go back 5-10 years back, all corporates used to say bill to company and company will settle the bills. So at the hotel, what was happening is that they will send the bills and then they will wait because the company will take 30 to 60 days to process and pay. So there used to be huge working capital which used to get stuck up. But over the period, what has happened is with especially a lot of new fashion companies coming in, companies don't have huge back office of their own, etc. What has been happening is many companies have moved to the model where each employee settles from a credit card and then the credit cards are settled by the company. So the companies implemented simpler solutions, and by companies implementing simpler solutions, they have reduced debtors at the hotel, and consequently the working capital requirement has also come down. Now this also impacts the valuation by improving the working capital requirement. So your less investment is required, valuation goes up. So these kind of changes can make an impact, we need to consider those. Very, very important thing is about capital expenditure. The CapEx, see, the assumption we were talking about is that when we were talking about terminal value is that the valuation of a business in a DCF model generally is done on the presumption that it's a going concern for eternity. Now, if a company has to be a going concern for eternity, at least the existing CapEx which is there needs to be replenished regularly so that there is the manufacturing facility which is in order and in running condition to continuously produce. Now, that is an essential requirement which will come up. So there has to be CapEx which is provided for maintaining the existing facility. So this is one. Second is, in the initial explicit period, there could be significant growth in revenue which is projected. Now, such significant growth in revenue projected, has it considered the appropriate level of capital investments which will be required for that? That is the second part which also needs to be considered. These two factors needs to be considered in evaluating the CapEx which has been plugged into the DCF model. Now, the general thumb rule I give is that if it is only for maintaining the facility, by the time you come to the terminal value period, your CapEx outflow and your depreciation by and large should be similar. So what were we saying? We are doing everything in current values. So we are saying essentially that if your depreciation is over 20 years, you also need to replace the machines over 20 years so that you can keep getting the company's business going forever. So as a thumb rule, it is a good idea to try and match the depreciation and CapEx considered in the terminal year to be close to each other. So this is a thumb rule which can also be kept in mind. That is provided there is no significant growth considered in the terminal period. And generally, it is not good to consider significant growth in terminal period. You should take only reasonable subdued growth in the terminal period. Gearing can also make value differences. We saw this already, whether I am going to have 20% equity and 80% debt, or 80% equity and 20% debt, all that could make a significant impact on the. There are other things which can have sudden impact. Forex. Now, this is a very interesting thing. Just look at this. CEO of Toronto Dominion Bank announced in July 6, 2006, they would buy the New Jersey-based Commerce Bank Corp for a Canadian dollar of 9.5 billion. So they were to pay 9.5 billion Canadian dollar to buy an American company. From July to October, only about 4 months. In October, they actually ended up paying only 8.5 billion Canadian dollar for the target. So they saved $1 billion Canadian dollar just because of the change in exchange rates. So wherever exchange rates are significant in your projections, please see that every factor has been considered appropriately in that. And the overall business logic is properly drawn up. For example, one of the major mistakes people used to do in projection is they'll say mine is an export, so every year the forex rate will go up, so my realization will go up, my revenue will go up, my cost will remain the same. But what history has taught is that whenever such changes happen, there is also an action by the buyers abroad. So there are negotiations and renegotiations, and the prices come down in dollar terms. So obviously, ultimately, your profitability margin remains in the same region. So these are things which needs to be considered specifically in areas like this. Now, few other things how to deal with it. One is contingent liability. These are practically things which will come up in our valuations. Now, after we have arrived at the value, right, some adjustment may be made towards contingent liability. So if it is a very small amount, you can say you are ignoring it, it is very small. If it is a mid-sized amount, you might say, okay, I'm taking a 50% because it's contingent liability. Obviously, it's not a fructified liability. So you are taking midway somewhere. If it is large, maybe then you take some evaluation, arrive at whether case to case, what kind of percentage can be put in as a risk attachment to it, and maybe even present some sensitivity if contingent liabilities were to fructify this kind of valuation, if it does not fructify this kind of valuation. All that can be in case it is materially large. Tax implications, of course, we have discussed already. Surplus cash is another thing I was talking about earlier briefly, but I want to specifically talk about. Many times there is a possibility that the company may be at that point when you are valuing sitting on surplus cash or cash equivalents. They may have mutual fund investments, they may have some other investments, etc., which is not into the business. So the business projections does not consider this value. It's only the value of the business which has been projected for. So this cash and cash equivalents are also additional value which is available to the company and the equity shareholders. So it should be added to the enterprise value to arrive at equity value. So these are additional surplus which is available, which also needs to be added. And a corollary to that is any interest income which has been considered from such surplus cash which have been deployed into deposits or mutual funds, etc. That also should be eliminated from the cash flow because that is not related to the business. So the projection should focus on the business value and everything else should be taken as surplus assets separately. Now, surplus cash I have dealt with. There could also be surplus assets which are there. Like you have land I was talking about. There could be surplus land which is there, which needs to be valued and taken. Those kind of surplus assets needs to be added. One very interesting thing which can come up, especially when you are dealing with some retail and all that, is negative working capital, where we have a positive working capital. We were showing in the discounted cash flow model, we take it as a investment or an outflow every year, additional outflow. Whereas there are some businesses where with increasing business, you sit on more creditor and you don't have so much of data. So you actually sit on negative working capital, increasing negative working capital. Now, if you do the DCF model in the normal manner and consider it, then it actually increases the value of the entity, which really is not there, because these are monies which have to be necessarily repaid. These negative working capital is not money invested into the company. It is something which you need to repay. So one of the three methods by which you can make adjustments is, one, you can ignore such negative inflow which is coming in, which may not be acceptable in some cases, but that is one option which can be looked at. Or may consider only the interest income coming from such surplus funds, but not consider it otherwise. Essentially, you need to do one of these to ensure, because basically these payments are a certainty, right? In all your valuation, you will have to consider that the payment which you have to make, the liability is a certainty. So it has to be discounted only at the risk-free rate, whereas your business is being discounted at risk rate, market risk rate. So the benefit you can get is only the risk-free rate from that and not the money itself. So that is why you can probably make some small adjustments for it, but you cannot take the whole inflow as money and discount and take it as a value. Surplus asset I spoke to you about already. Investment in a subsidiary. Now, this is an interesting thing. Normally, investment in a subsidiary could be of different types. Let's suppose if it is part of the business, so then ideal would be to consider valuation based on projections which are on a consolidated basis. Now, where it is not part of the business, or where they are separate businesses, or where there are separate projections, etc. available and only available, you could consider them separately and value it and add it up. There could be also share application money. Of course, nowadays with cap being put on the timeline, this has significantly reduced to a lower this thing. But there could be still share application money lying at the time you are doing the valuation. Now, in share application monies, you need to deal with it on a case-to-case basis. First of all, you need to understand what is the share application money, what is the arrangement behind it, what is the conversion rates or issue rate price which has been agreed upon for that. All that needs to be clearly understood and then accordingly made adjustments for in the valuation. After you arrive at the general equity value, then you split it between what is to go for the share application money holders and the equity holders as of today. Same with regard to preference shares. And in preference shares, there could be much more complexities. Now, you have to deal with, after understanding each of its nature and the convertibility structure, and individually deal with each of them. So CCPS, the one way could be to convert it into fixed number of equity shares and consider that as equivalent equity shares for determining the value. CCPS, which are convertible into variable number of equity shares based on future performance, here you may want to adjust it based on some assumptions as to what it might convert it in future. Optionally convertible preference shares, you could use stock option models which are there. Of course, there are separate valuation techniques itself for options which are available. So you can do a stock option model based valuation for that and take that value for OCPS. Redeemable preference shares could be treated as a debt because these are, though it is called as a preference share from a valuation perspective, it is purely a redeemable instrument. Money has to be paid back. In all this, what we need to understand is there is no single solution which will apply always. We need to think on each case, considering the actual facts and circumstances in the particular case which is being valued, and accordingly apply it. But these are some principles which can be looked at and considered in doing the valuation. Another interesting thing which comes is the short-term debt or bank overdraft. Now, internationally, if you see the DCF model, they don't have the concept of this bank overdraft, working capital limit versus term loans, all that they don't have. Everything is a debt, that's all. We only have these confusions. So in India, typically what we were doing in the past was that all debt was considered as debt, including bank overdraft, etc. But there are two options which are available. One is to consider your bank overdraft, working capital limits, etc. as part of your working capital, overall working capital change, right? If you do that, accordingly, the interest for that also should be taken as part of your cost and not as your cash outflow and not excluded. So this is one model which you can look at, where you are considering it as part of your working capital change, and the cost relating to that working capital debts is also considered as an outflow. The second option which could be looked at is to eliminate this also as debt and consider them as debt, part of the debt. So one of the two you can do, but again, consistency. If you are going to prepare your DCF on that basis, when you are doing the debt deduction from the enterprise value, you should also deduct this debt. So that's something you need to carefully apply. Further capital infusion is normally not considered in DCF valuation because that has no relevance to the valuation as such. However, like I was mentioning, this is very critical to consider from the projections, the reasonability of the projections itself, because sometimes the projections will be made in such a manner that future infusion of capital is mandatory for you to achieve these numbers. Now that means then today you are not in a position to actually reach those. Whether it is fair to consider those and take the value benefit of it today when that equity has not even come in may not be appropriate. So that is something which also will have to be factored in the way the projection is calculated. So these are two concepts which I first want to put across: pre-money and post-money valuation. Now, a DCF valuation generally gives a pre-money valuation because you are calculating as of today and what investments, expenses, revenue, all that is going to come. You are not talking about how much cash is going to come in. So generally, so it is a pre-money valuation which normally comes up in this, right? The value of a business after a capital infusion will have to incorporate the cash that comes into the business, pushing up the post-money value. So today, if I value the company at 100 and I am raising a fund of another 100, the value of the business after the capital infusion becomes 200. So this is something which needs to be considered. And pre-money, post-money valuation is very important because for the reasons I told you earlier, that sometimes the infusion might be mandatory for you to be able to achieve the projections, not to compute the projections, but to achieve the projections. So in such cases, how do you deal with it is something which needs to be clearly factored. Now I will take another 5 minutes on some of these discounts and WACC before I talk about the opportunities which we have and what we can look at, etc. Weighted average cost of capital, I explained already from the Excel sheet. So this is the formula for it. And I only want to reiterate where we can get the data from. So RBI publishes this ZCYC data. Nowadays, there is this report which is being published by FBIL monthly. FBIL. So simple is to just take from that. It's easy, readily available, and it gives for multiple tenors. You can take a tenor which is more suitable appropriately. Equity risk premium. As I was telling you, you have two options. One is you can take a long-term return calculated from the stock market, and then from that deduct the risk-free rate to arrive at the equity risk premium. Or alternatively, Ashwath Damodaran's website publishes ERP data for India also every year generally. I think during COVID alone, he published twice, but otherwise generally every year. So that could be sourced and used readily. And these are all public domain information. There is no need to subscribe to anything. Beta, again, like I told you, you can pick from Ashwath Damodaran site itself data, or you can compute beta. There are ways of computing beta for listed companies based on the stock market data for a long period, 5-year data and things like that. You can take and calculate. But I would suggest the simpler solution of just taking it from Ashwath Damodaran site. Anyway, all these are estimates. So you have to have a source and rationale of the right selection for the estimate. That's all. So what is beta? Let's just understand that. So the concept is clear to us, right? So beta factors are derived by, so basically beta indicates the systemic risk which is there. Beta greater than 1 indicates above average risk, while below 1 means relatively lower risk. Now, in a rare case, it could be negative. Maybe in the case of something like a gold. 0 cash or GSEC, it's not supposed to have any risk. So theoretically, these are the examples of that -0, what can be there. This is theory. In practice, you might find something is having a negative for God knows why reason, but generally you don't find. Less than 1 will be lower volatility like healthcare, etc. Equal to 1 will be the what is comparable to market like an index fund. Greater than 1 is those with higher volatility. One example is advertising companies and things like that. So generally they have a higher volatility. Healthcare and all have a lower volatility. So I think I'll skip these. Like I said, the simplest thing is to take beta from the Damodaran site. I'll skip this part. I want to talk about some of the discounts and premium. Now, whatever value we have arrived at, now let's look at two things. One is the relative valuation or multiple based valuation. So there, what have we done? We have taken the multiple from the listed companies, and then we have applied that to the company which we are looking at. Now, all these multiples which are generated by the listed companies are based on transactions which are happening in the stock market and the prices at which the shares are being traded. Now, we all know generally the stock market trades are for retail number of shares, so non-controlling interest, right? Generally, that is what is getting traded in the market, so non-controlling interest. So typically, the relative valuation measure generally gives a non-controlling interest level value, whereas a DCF is prepared by the company. The DCF is based on projections which only the company's management and the promoters, etc., are aware of. And based on that, you are discounting and arriving at a value. So typically, the DCF valuation generally gives a controlling interest value. So this is one thing we need to understand. So a non-controlling interest value and a controlling interest value. So to this, you may want to adjust for the control premium or minority discount as the case may be required. So this is one aspect of discount which needs to be considered. The second one is both these methods presume, because they are basically coming from data which is there in the market. Many a times the market data might presume that it is a tradable commodity, whereas many of the companies we value might be non-tradable. So illiquidity discount may be required to be applied. So that is another thing which may need to be considered. Company risk discount is where you are making adjustments for differences between the comparables which you have used and this specific company, or in the DCF kind of a thing where you have projected only your company's data. You may still make a company risk adjustment, discount adjustment, because of the specific risks which you think are higher than the market risks for this company. So that might be one other thing which can get adjusted. Business size discount or premium is an interesting thing. In India, typically we find that the business size is a discount. That is, the smaller companies get a discount, bigger companies get a premium. Whereas in the very developed market like the US, the larger companies get a discount and the smaller companies get a premium, because the growth rates of the smaller companies can be higher and the larger companies have plateaued and their growth rates are stagnant. Whereas in India, it is still different. The larger companies have a higher growth rate and the smaller companies do not have such a higher growth rate. So generally, you find that there is a huge difference in the way market perceives a business size in India and abroad. synergy premium is what we were talking about, that where you can bring in 1 + 1 to make 3, because you are going to be able to shave off some of the common things by bringing in what you already have with what you are going to get now. Key percent discount is where the business is very highly dependent on some key people. So that could be one thing which may have to be adjusted for. Trapped in capital gains discount is, again, many of these valuations, when you want to unlock it, there is a huge capital gains which is involved. So for example, let's suppose the company has a lot of surplus land. You take the market value of the surplus land is what would be one approach. Now, another approach could be, why would I take the market value? I would take market value less capital gains tax which has to be paid on it, because I cannot encash it without the cost. So should I pay so much? Could be the question. So that is another thing which may have to be considered. Block sale discount or premium. This is when you are going to sell a large chunk. Typically in the valuation, this thing, if you are holding less than 1% shareholding, it has some this thing, you have 1% and all that, it has something, you have more than 5% or 10% based on the company law benefits also which flows with that. There could be some increased valuation coming, 26%, 51%. So a block sale could be a 20% block or a 15% block, which could make a big difference to somebody who's buying it. So there could be a premium attached to it. Sometimes there could be a discount attached to it because nobody wants to hold a minority block. Let's suppose 75% is held by the promoters. Now you have a block of 5%. Nobody wants to buy your 5% because by paying a premium, because it's going to be a millstone because the promoter is sitting with 75% anyway. So these are things which needs to be considered. I have given some models also which are available on the site to give an idea, and for control premium also some data which can be readily used from these presentations also. That is why I have put in here, but I'll skip these. I'll skip the valuation process also, which is basically going back to saying that please document everything and put in your report as much as documentation as possible. So now, next 10-15 minutes, I just want to cover about the opportunities which are coming. Again, I don't want to go into individual act and individual specific requirement under act, etc. See, many of these companies which are coming up for valuation, there are a lot of opportunities which are coming up for valuation because of various requirements. Now, Companies Act fully has brought in the need for valuers. SEBI is also changing all new changes they are making. They are changing it as valuers. So they have brought in for investment trusts. They have brought in for REITs. Wherever they are changing, they are now bringing it as valuers. So that is something which we also need to factor. FEMA requires valuation. Income tax requires value computation mostly, not a valuation per se, but more of a value computation. But these are very strong areas with so many small companies, big companies getting in either inward remittance or outward remittance. There's a huge amount of FEMA related valuation also, which is available in this thing. Now, our ethical standards very clearly has restrictions. The auditor cannot do valuations. Now, in a scenario like this, when you are already in a second tier city, what you can look at is wherever you are not an auditor, you can say that you can pitch in for valuation services, which is a non-conflicting thing. So even your professional brethren has somebody who can deal with some part of this, which he cannot do. So there is an opportunity available for everybody in these things. Otherwise, generally what happens is many of these company law valuations, end up going to company secretaries, because they are the ones who are filing with the ROC, etc. And generally they go to another company secretary to get these valuations done. So these are some specific things where you can look at valuation. Second is, there is a lot of change happening in the business. Companies are looking to raise funds. Companies are looking to sell out because the next generation doesn't want to be in this business. They've all studied something else and they have moved into some other profession or business. They don't want to be in their dad's business. So there is a lot of opportunity happening for sale of businesses in the SME segment, and also raising investments in the SME segment. Now, this is another area where you can advise your own clients. And to do advisory, you don't need to issue a report at all. You can be there to help them and realize good value, so that you have a great relationship and a continued business with your own clients. You can solidify by looking at what can be done to improve his own this thing in terms of what value realizations he can get. Now, largely, those are areas where merchant bankers and investment bankers are working with them. Now, you can work along with him in as a representative of the company's owners to ensure that you are giving right advice and perspective to your client to go in the right direction. So it makes a lot of this thing. Accounting, 2-3 areas where there will be regular work is, one is for all the company law filings, any FEMA filings, accounting requirements. A lot of companies are now required to do ESOP valuation, and ESOP valuation and all is very, very simple once you have the tool, and that tool is readily available. Black-Scholes calculators are all readily available. In fact, you all should take one session on ESOP. Wherever companies have ESOP, you can do valuations for that. All this you can do sitting from here, not only for your clients in your city, but across. All these do not require you to necessarily be present in the city of the business also. So these are things which you can surely look at in terms of the opportunities in this area. So I'll just go to accounting standards. So many such things which requires valuation, right? Wherever there is an asset valuation, investments have to be valued every year. In fact, some companies do valuation every quarter for the unlisted investments because they have so many. Of course, properties you leave it. We may not be the competent people to do property valuation, but there also some companies do property valuation based on rental discounting, not based on market value of properties. So there again, it's purely a financial valuation. We can look at doing that. Then impairment testing, wherever investments have been made, whether there is a need to impair the cost. So those are also areas where we can do quite a lot of work. Like I said, RBI on FEMA, there is a lot of valuation. Income tax is purely a computation exercise mostly, so it doesn't matter. SEBI, leave it. It's all, again, wherever they are newly coming in, they can bring in. Now, interesting things like even stamp duty and all that, there is a requirement for valuations to be done, but many of them to do with property, so it may not be right in our area of valuations. Like I was mentioning in SEBI, wherever new regulations are coming in now, they have put it for valuers, like the REIT, etc. Insolvency and bankruptcy code is a big area where potential is huge. And generally, the requirement is that, if the company has a full balance sheet, then including the plant and machinery, land and building under SFA, 3 people will have to do valuation, and the SFA probably compiles it and gives it. So there is a huge opportunity in terms of any companies going into IBC also, where valuation services can be provided. All this only by a registered valuer. So that is the key. With that, I would like to end my presentation. What I would like to specifically state is, can valuation by itself be a separate business line with no other this thing? Can a valuer be only valuer and nothing else? I don't think so, not in the current context. And this is what I told IBBA also when they were doing a survey on this. There are some thoughts in IBBA that they want to make valuers as a separate profession and bring in rules which might prohibit valuer from practicing as a CA or CA practicing as a valuer, etc. in future. But as of now, that is not put in. And as of now, I don't think the market is such that a valuer can do only valuation throughout the year and have it as a single line of business. I don't think it's matured to that. But surely for a chartered accountant, as an additional line of business, there is a great opportunity here and option for those who want to choose this and move forward. There's a great opportunity. Thank you. Any questions? I can take it now. Or anytime. I have given my mail ID also in this thing. Generally, I am very happy to reply to any queries people have on valuation. And normally, I try to reply within 24 hours, any mails which I get. That's normally. Very rarely, during this audit pressure times and all that, it might get a little delayed, but generally I would be very happy to reply anytime.
If any members is having any questions, please ask. I think, sir, you discussed it thoroughly. So I don't think so. The members have any questions.
No, mostly I think it will also come up when we do evaluation. So that's why I'm always available anytime when they are doing a practical valuation. Any queries they have, anybody can please write to me anytime.
Yes, sir. We'll definitely share your mail with the members.
Thank you.
Thank you, sir. Sir, now let's proceed for vote of thanks. Sir, it's a proud privilege to give vote of thanks on behalf of Nashik branch. Thank you, sir, for taking time from your busy schedule and guiding the members on valuation of shares. Sir, you have enlightened the sessions by covering practical cases in relation to valuation of shares. It will definitely upgrade the knowledge of our members. Once again, thank you, sir, for guiding us. I hereby declare that the session is over. Thank you, sir.
Thank you.
Sir.
Thank you.